This is Peter Bell with a message for Ron Murphy, June 25th, 1 a.m., Victoria, BC, Canada. So I was talking to my friend John Fammy tonight, and we were talking about contract mining at the Lexington and running some of the prices on comparable land packages in public markets. And we were kind of getting like a $600,000 number approximately plus. And then we discussed how, those are for properties that maybe are just mineral rights. But maybe those are a bit better mines, so maybe Lexington is worth less. One way to make Lexington worth more is to go and rehab the shafts. So there's several mine shafts on the property, and these deserve to be investigated and worked on immediately and aggressively. This is not something I'm equipped to do. I don't know anybody to hire to do this work either. But you, Ron Murphy, are the guy for this, as far as I know. I think it might even be, if you do get it rehabbed, there's the production side, but maybe even an education side too, if you want to give people a tour of what an old mine in Oatman looks like, right? So my goal is to take it from a vintage property that's never been worked in modern times to something that's like a demonstration property or even a profitable going concern. So I think the best way to do that is to find somebody like you who knows how to put a mine into production and incentivize you to do it. And lots of ways to talk about doing that. I'm trying to think of ways where I don't have to give you cash. And I don't really want to give you stock either, because I think you deserve more than that. So the idea that I came up with was to let you keep all of the profits from an operation for the first $1 million, say. And then after that, something happens. And I would say that you get a 1% royalty over the entire project. And then we can renegotiate ongoing work, right? You can still have a profit, you can still be the contract miner, but that will be under a separate agreement, right? So the duration of this agreement is 2 stages, and the goal of it is to incentivize you to get some production out of this mine. And my thinking is that if you can turn a $1 million profit on this in under a year, then you can show it's a very bullish setup, right? So one way to incentivize you to do that is to give you all the profits. I can afford to do that because I don't have the profits right now. So if I forego them, what does that matter? Can I survive without them? The answer is yes. And then the other way to incentivize you is to give you project level equity. I don't want to give you company stock because the company is more complicated than this project. So I just want to incentivize you on the project level specifically. And the way to do that is with a royalty, because this will give you a residual interest on a passive cash flow basis in any future production at a specified rate. So you are getting project level equity, and it's permanent equity too. And it's not dilutable. It's a specified rate of participation. And it does not require any matching funding or purchases or any borrowing or underwriting, no obligations in any way, nothing, just a royalty interest. So, and I would think 1% is a place to start for that. At first I was saying 2, but that's probably overkill. It's probably bigger than it needs to be, because we give it too much the royalty at first, and then what do? This is the top line royalty too. It's not a profit participating interest. It would be a smelter royalty, I guess. You could call it a smelter royalty. Net smelter return. I don't know. I would say give you 1% of the top line. Doesn't have to be 1% of the bottom line. I would say 1% of the top line of all future metal production at this claim block, and add an AOI, area of influence, area of interest, where if we stake any claims or have any production exposure, in his surrounding area, maybe not. I wouldn't actually. I'd change my mind. I would take the AOI out of it in this case, because we're not dealing with staked claims. We're dealing with patented claims, so they deserve to be treated differently than the Canadian context. And we're not going to be staking because the area is already full. So maybe you could have a really small AOI, like a 1 kilometre AOI, or a half a kilometre. I would be okay with that. But that's kind of a subtle, detailed point. And we shouldn't let that hang us up, because the broad strokes are that after you've generated $1 million in profit from mining this project on a trial basis, on contract mining with toll milling, where you're digging up rock, you rehab the old shafts, and you go in and you face some ore, you take small amounts, and then you send it upstream, up a mile up the road to the Gold Road mill and mine that Aura Minerals has, and you give it to them as test material, and then they'll take it as toll milling, and so you, the contract miner, gets the residual entirely, and so you're incentivized to put as much high grade through as quick as possible so that you can squeeze $1 million out of this on a profit basis. And then after that, you get this residual permanent project level interest, because what you've done for the project in this first campaign of mining shows that it's mineable. Assuming that you can successfully pass this yardstick of a $1 million profit line, that says something about the merits of the property. Right? Right? Like, this is a good hurdle, and passing it is like a good test. And the quicker you pass it, the better. So maybe it's like, you get 2 points if you pass it in the next 6 months, and you get 1 point if you pass it within the next year, and then if you don't pass it within the next year, then you don't get anything. There could be some tough timelines and structure in the contract to, really incentivize you to put the hammer down and get it done as quick as possible. And why would you do that? Because doing it quicker is more valuable. Not just on a cash flow standalone basis, but on a project valuation basis. If you can show that you can go in and contract mine at a tremendous rate, then the analysts who try and value this out at scale or on a continued basis have to consider that. And they consider that differently than if we were very slow to get the same amount of production, or if you couldn't do it at all. Right? And when I say production, I don't mean production of metal, I mean production of profit. So we are, financially motivated here. And that's why the toll milling fits with the contract mining, and to give away a residual interest, because we're really doing, financial derivative stuff here. There's an operational side, and then the real play, though, is this financial angle, because, as I've said, if you do a $1 million profit privately on a fully contract basis, you go from a project that, maybe it's worth 600 grand. No, maybe it's less. To something that's like, what? What's your run rate? Oh, wow, well, you're 10, 20, 30, 100 times earnings. A small scale, what's your growth rate? Yeah, you're growing that fast, huh? Wow, you're growing at 50% a year. You're growing profit at 50% a year. You get 50 times earnings? 150 times earnings? Pick a number. The valuation metrics in the financial markets right now are so screwy. They're broken beyond repair. It's unbelievable. And so this is an advantage to us, because mining has a very nice feature where it can be kind of scaled up or scaled down. depending how aggressively you work an ore body and how big it is and accessible, right? So if we can start small and then crank up the volume, then, some people will be like, well, that's a little cute, and they'll discount it and be like, oh, well, you started small just so you could show me a 50% growth rate and say that I blah, blah, blah. Maybe. Or maybe we can sustain the 50% growth rate. Maybe it goes down to 40% per year, and we keep that going for 2 years. That's a double. Come on. Hate away. There will be people who will like this. It's a very simple play. It's a very important play. And it's just a cash flow play as well. But because it's a gold production story, there's this whole other aspect to it where you have the religious gold bugs, right? So they have a whole different set of valuation metrics. And most of them aren't used to seeing cash flow, right? So if you have small-scale, high-grade production on a fully contract basis, what? Privately? And what did it cost you? Oh, nothing? No stock? No cash? Hold on, what? How did you... Oh, well, contract miner took the profit line, and the toll miller took what they needed to take. And, the contract miner was really incentivized to get it done quick because they have a royalty now. Yeah, and so we're raising $10 million to do a 50,000 meter drill Sorry, no, we're not. We're raising $10 million to build out the mine shaft down 400 meters. Because we've done some deep drilling and had high-grade hits at depth, so we're expanding and modernizing the shaft, and we're, continuing with this toll milling story, toll milling contract mining. The only step we're adding is more processing at our site so that we are shipping a consistent, high-grade, high-quality concentrate to the Gold Road mill. Because they don't have huge capacity there necessarily. We don't, we're guests in their mill, right? So we want to ship them the best stuff we can. So we've been doing our own crushing, screening, qualifying, improvement work on the ore that we've been taking out of the underground mine that we've been doing at our project. That's where it goes on a 10 million, 20 million, 50 million cumulative spending program for this Lexington project. And the street gets behind that in a major way if they see, 1 million profit in 6 months on a turnkey basis. Is that realistic? $1 million, $2,000 an ounce. Is that really 500 ounces? It's not a lot. It's also not the right number. So what's the right number? Twice that? 3 times that? 1,000 ounces? 1,500 ounces? Well, 4 times, 5 times? 2,500 ounces? Can you get 2,500 ounces out of Lexington? And what would it cost per ounce? $2,500 ounces. Say you can find half ounce per ton material. 5,000 tons? 5,000 tons? Half ounce? Hold on. Are those numbers right? So help me out on this stuff. But I have to believe it's possible. I have to believe it's worth talking about, and it's worth sending Ron and his team to site to look at this place and be like, okay, where exactly do you have what property rights? Right? And what can we do here? Because it's not obvious, and it requires a lot of training and capabilities that are very expensive. If I have to pay for this in cash, it's cost prohibitive. But if there's a way to share the winnings, then it's a question of, can this crew justify the expense up front to take the gamble? I don't know the answer to that, but I have to assume that there's a way to try it. And maybe, maybe the stock movement that happens is that our company that has this option on this Lexington property, it can pay Silver Bullet in stock. And then Silver Bullet can pay the cash costs of the contract miner. Right? Because a little bit can go a long way. If we're talking about 5,000 ounces, $1,000 an ounce mining costs with the toll milling? If you're lucky, $1,000 an ounce costs for 5,000 ounces. That sounds like a $5 million cost. Sounds like a lot, right? Do you have to, well, is it a lot? Maybe, maybe not. You can budget for that full $5 million in costs as one slug, or you can say, okay, we're doing this over 10 months, and we're going to do $500,000 in cash costs a month. And that's going to be a complete turnover, where we incur those costs, we ship them to the ore, and we get paid back, and we use the same working capital to do it again next month. That's a $500,000 turnover per month. Realistic? Without any cash to defray, directly from my side? No, probably not realistic. If Silver Bullet puts up some money, maybe, but they don't have six-figure checks to be underwriting $500,000 at a time. Maybe on some maybe production at something that you're toll milling down the road. Maybe, but take a zero off it. Why do 500 if you can do 50 or 100 or 150 or 200? Start small, show that you can do it, and then again, starting small gives you the higher growth rate if it works. Right? Like, all this starts with a day visit, and then what? An exploration crew to go rappelling underground and check mine access, and then what? Some kind of geophysics to track the shape of the old workings, some detailed ground radar, seismic, passive seismic, ground radar, ground penetrating radar, LiDAR, handheld LiDAR in the old workings as much as you can get around. Like, you get in there, you start doing structural mapping, and then you get onto grade and sampling. And is there any ore? Is there any ore exposed in this old Lexington mine? I don't know. I can't tell you yes or no. I think so, but I don't. But nobody's been in the mine. We sent some guys to surface. They went on their own dime. Some placer mining gold hunters. They couldn't find a sniff. They couldn't find a color of gold. They found some rock with silver in it, but they couldn't find a color, like a grain of gold. That's at surface. So, does that mean there's no gold around? Or does that mean they were in over their head? Theoretically, they crushed some rocks from a dump and did some sluicing with them, but didn't come up with any visible gold, right? So, what does that mean? It means they're doing something wrong. They're better off crushing the rock. Yeah, sure, you could put it over a sluice. And then bag this fine material and then separately from the coarse material, or the dense material, the light from the dense, right? You could take the stuff that comes over your sluice table that doesn't get caught and put that in one bag, and then you could take over the other stuff that does get caught and put it in a different bag. Keep repeating that, and then take those bags to the Gold Road mill and say, hey, can you run these and tell us what you think? And, the likelihood is that the heavy stuff, the stuff that gets caught in the sluice table, it probably has a significant upgrading factor on the gold grade. So if the whole sample is like 0.1 grams or 1 gram or 2 grams, I don't know what there's surface grabs we've had that have been 3 grams, and then supposedly there's stuff in the dump that assayed a half an ounce. It's probably out there, but my sense is that area has been picked over because it's in Oatman, and there's, gold mining tours, ATV tours, all kinds of people hunting for rocks and stuff out there. So any obvious stuff's been snatched up by a bunch of different people. So the old workings, different story. But at surface at Lexington, it's too much of an easy area to get to have any good material just sitting around, I think. And that was borne out by the guys we sent to go there. But that's not to say that there's not gold in material at the surface. And one way to test that is what I'm just describing, where you go to the dumps and you do free dig, all the material you can, and just, 500, half a ton, 2 tons, small scale stuff, put it through small rock crushers and sluice to do gravity separation, and then send the different bags off to the Gold Road Mill up the road and a mile away. How many times to repeat myself, but it's such a simple idea that puts a foot in the door, and from there, you go into the underground workings and you see what you can do, and you do more stuff at surface. But who's paying for this? Who's doing this? Who's doing this work? Like, on what basis? So to start with, the play, I think, is to do it all privately. And I think there's material you could get from Lexington that you could take to the Gold Road Mill, that they would toll mill for you, and it would turn a profit. Again, I have to believe that. I don't know, and I may be dreaming, but let's find out. And if it's a case of like no capital is required, then okay, get the capital. We can do this, right? We can do it financially. We can do it technically, right? Is the ore there? I don't know. I can't tell you. But I'd rather go and try and mine it than try and explore it, really. Especially because these 3 old shafts or more. So let's use them. And something I was going to say that I can't remember what it is. Sorry. Well, I'll say that, like, this scenario with the toll miller right there is pretty unusual. And if they're I don't know what their flow sheet looks like, but they're an underground mine. And so if we're going underground at the Lexington, then we match, right? So the Moss mine with Northern Vertex is like a big open pit nearby. I do not want to be doing quasi-bulk tonnage. Maybe you could send them a high-grade concentrate to sprinkle on their pad and juice their gold production. But mainly, I would think first you send stuff to the underground mill because you're doing stuff from the underground. If you really wanted to get creative with it, when you do that surface work with the crusher and the sluice, you could send samples of both to Northern Vertex as well. I would guess that they like the light material. It may be lower grade gold, but after it's come across the sluice, it may be higher than what their ore is, right? That's a possibility. So you may want to send them some of the lighter stuff that comes down the sluice and washes out. You can send them some of the heavier stuff too for them to test. Either way, if they blended it into their ongoing stacking, they could potentially increase their gold production, right? And, whatever Gold Road mill, I think they're doing vat leach. And so they can just, we're going to use up some of their carbon in pulp solution for gold precipitation? Like, I think they can accommodate. If we're giving them material that's higher grade blend than what they're mining, and it doesn't screw up the mineralogy and the metallurgy, then let's play ball. So I think there's a couple ways to win with that, just with surface sampling, but I think the real prize is the underground stuff. And I don't know if I'd send the underground stuff to the Moss mine. Maybe, if you have some nice material that they can, it's worth it. Look, you have 2 operating mines in the area. Let's generate as much sampling test material for them as we can. Please, as soon as possible. We only have a small acreage. Let's use it. We're not doing exploration. We're literally brownfields restart scenario. But from so long ago that it's practically useless. Or maybe even in some cases an impediment. So some of these old workings, they might be a liability. And it may not be safe to use them. I don't know. But even if they are, a problem, this is where the contract mining comes in. If you're teamed up with some of the best contract miners who actually know what they're doing, it's a story that writes itself. And that's why I say, give the entire piece of pie, give all the profit line to the contract miner on an initial campaign. And then to show them great respect for what they've done to, increase the property value and demonstrate the potential of it, give them permanent property equity, a royalty. Let's go. And then, I don't know if Arizona has a way to register royalties or whatever. Probably not. It's pretty disorganized down there. That's fine. This is an Arizona guy, Ron Murphy, right? You are, Ron. You're an Arizona guy. And we're giving you a royalty on a property owned by guys in Arizona. And sure, my company's involved, but the royalty will be specified with them as the underlying vendors, right? You will have a legal agreement with them, because when I optioned the property privately, I did not have a royalty. They did not take a royalty when they gave me the option. They did not include a royalty for their side as the vendors originally. They gave it to me. And our agreement says that I can chop it up however I want. So I can create a royalty on this property and establish an agreement with you and the guys who own it outside of my option agreement with the guys who own it. So if my option gets canceled, the royalty you have still exists, right? That's permanent project level equity. If or when I buy that property with my company that has it optioned, that royalty still exists. Again, we have this in Canada. I'm assuming that this is something we can do legally in the States. I believe it can clearly be done. One of the biggest questions is the person who has the royalty, if they neglect to monitor and it goes into production and they're unaware, then there can be a concern. And that's why having the contract miner involved on an ongoing basis is a win. And maybe another way to help that monitoring happen is to give, company equity to the company where the contract miner is a director, the public company, right? Because then this Lexington project has a foot in the public markets. Even if it's just that, Silver Bullet has stock in this private company called Lexington Co. Right? Yeah, there's this project company called Lexington Co. They'd carved off a royalty and gave it to this guy who's a director of Silver Bullet. And now Silver Bullet has a bunch of shares in Lexington Co. because Silver Bullet paid the contract miner in a related party transaction to mine the Lexington Co. on an initial basis. And then the miner, you know, they were, the contract with Lexington Co. allowed the miner to keep all of the profits from the first $1 million, and then they earned a royalty. And then we have this situation where there's this Lexington Co. private company that's sitting on a project that just turned over this money, and Silver Bullet has some stake in it from the Pubco exposure, and there's all this stuff, these really dense connections. These are how you get like powerful situations that are kind of like resilient or anti-fragile even, right? You can have situations where the network is like self-reinforcing in some ways. Those are like the best. And I think that's possible here. I don't know if the $1 million in under a year part that I was saying is realistic. But if you need to make $2 million in gold revenue to make $1 million in profit, those are different numbers from what I was saying before. $2 million in profit, $2 million in revenue is like, what, 1,000 ounces? 1,500 ounces? So then the question is, where are the ounces at Lexington? Is there a pocket of 1,000 ounces? Is there 10,000 ounces? Is there 100,000 ounces that we can find in and around the old mine that we can get to? Is there 500 ounces? Is there 1 ounce? Is there any gold at this property at all? Right? And I'll say again, the old timers mined here, and there's at least 3 shafts, I believe. Some 300 feet deep, 500 feet of workings off, maybe. And my intuition is that they didn't do a lot of mining down here because they got a lot of water. And the reason I think that is because this area is downslope from the Gold Road Mill. So I think there's about 1,000-foot elevation difference. And then take, 300 feet below that to get down to where the supergene zone might be. Boom, you're talking about the basin of the Oatman Hills. Southern basin, drainage basin. Could potentially be a lot of water going through the Lexington area. Right? All that water, that's what stopped a lot of these underground miners. They kind of stopped at the water table. And here's some geology. The water table that the old timers were facing may be different from the paleo water table where the supergene zone occurs, right? And specifically, a scenario where that happens is there's some crustal thrusting or something like this, where you used to have a rock unit that was flat, and then there was weathering, and there's this supergene zone that extends, in pockets around Oatman, and that happened back when the whole rock unit was like basically flat. So it all happened to around the same depth at different places, and then boom, something happened and stuff moved and pushed, and all of a sudden part of Oatman got thrust up and part of it fell down, and we're in the part that fell down. And so where the paleo water surface was, that is now the supergene zone, it could be more than, it could be below the top of it could be below the water table today, right? So the it could be below the water table today because that part of the rock has been thrust down. So where the old water table is, keep that the same, and now we've been thrust down into that, so we're below. The old water table is below where the current water table is, potentially, if this crustal story, rock unit story of, and maybe the water level increased where we are too, because we got put into the bottom of this drainage basin, so more water kind of came towards us in the ground. Lots of various kind of technical stories that can explain that, but that's all to say that if you went in the Lexington mines underground, you may find that the guys had some good strikes, but they didn't get into the supergene. And it could be that they're 100 feet up from the supergene. They could be 20 feet up. They could be 50 feet up. They're probably not 150 feet up. If they're 300 feet down already, how much further could the supergene, like, maybe they were into supergene? I don't know. Let's go find out. But there's good reason to believe that the old-timers stopped the mining at the Lexington because they hit water. And I think that water could very well be above where the supergene zone is at this area. And again, the reason I think the Gold Road mine historically was mined and this one wasn't is because the Gold Road was 1,000 feet higher. So the water table was lower. And if you believe me about how it used to be a flat thing that they got pushed up and dropped down, the Gold Road mine is an area that got pushed up. So not only is the water table less because you're higher up, 1,000 feet higher than Lexington, and you're in a ridge as opposed to a basin, but you're also above. The paleo water table is above where the present day water table is because this part of the rock package got pushed up, right? So the Gold Road mine, the paleo water table, which is where the supergene zone is, it got pushed up, and so that meant that the water table there was below the supergene, which is why the old timers could get into it, which is why the Gold Road mine was like the biggest one in the district. And I think that if you go and you look at the Big Johnny, I think was another one that was significant size. I think it was up on a ridge as well. So I think there's some history about the biggest mines from the 1800s were up on ridges. And so for us to be in kind of a basin that's low and has a lot of the same geology, and has shafts. We don't know how deep they are. We don't know what they were getting out of there. Again, there's this story about like these town dumps and how, there's these big waste dumps around the Oatman town. And it's like, yeah, those are probably from this mine, that mine, all of them combined together. So whatever was mined out at Lexington area probably ended up in the Oatman town dumps, I think. There's maybe some of it still at site, but not much. I think most of it got moved by burros, a half a mile. Because it's a mile from Lexington to the Gold Road Mill, but it's more like half a mile to all these old dumps in the town. So who knows what the history and where the waste material for all this stuff is. I don't really care. You can get into your age dating and do some science at some point. But for now, all I want to do is find out where's this hot ore. And if we have to go down and do a shaft that goes down 500 feet and goes into a water table and we have water issues, we can deal with that as a modern mine. If we know we're getting into a wet area that's competent rock, we can design a mine around that and proceed. Financing, that's a very different story. But if we can get underground and do some small-scale production to turn a profit, then we'll turn some eyes. And then if we go underground and do some underground drilling and hit high grade below and around, then the eyes that we have looking at us will turn into money being offered to us, right? That's the promotional business. You want to have results first and ask for money later, and you want to make sure that you understand that you're in I think junior mining, you're in the news flow buying business. I don't think it's a cash flow business. I don't know what exploration is, but I think whether you're in exploration or production, you're in the business of buying news releases. You want to buy hot news releases about how exciting your mining projects are. And this scenario I'm sketching out is meant to be the kind of simplest, safest, easiest place to start, right? Whether or not I actually got that across is up for debate, but that's the thinking, right? The thinking is, where do you find partners and allies and make your network more dense and interconnected? where do you do things to help other people? And if you go into this scenario to try to help other people, that's how you grow the value of the situation overall, right? Because again, come back to these numbers about what is it worth to just flip it now on a comps basis? Sure. Now, what is it worth if there's production? Oh, and what is it worth if, right, there's underground exploration after the production? What? You know, and what if you then modernize the underground access and expand on the underground shafts and underground mine workings? Whoa. Well, what's the multiplier on the cost base for Ron Murphy to go and rehab the shaft, build new levels, and even drive deeper versus the impact, the delta on valuation for the project? What's the difference in Ron's cost versus the delta in project valuation from a public markets perspective in a bull market with two operating mines as your toll milling partners? You're sending feed to both mines. And you're doing your own private underground mine development to keep, right? That's a small scale production story. How much is the production effort accretive? What do you do with the cash? Do you turn a profit on net cash flow basis? I honestly think that the multiplier is significant, and even to privately fund out the rehab of the entire old mine workings and comprehensive documentation and sampling, I think that's so accretive. That, if you can get $400,000 for Lexington without setting foot on it, what can you get if you have a full data suite and ongoing toll milling, contract mining, production scenario, complete with, the team and the people necessary to continue operations and even increase scale? That's serving up something to the street that they don't often get. They're screaming for deal flow like that. What does Aura pay for that? What does Northern Vertex pay for that? Whole lot more than $400,000. What does it cost to get there? These are the questions. So I don't know the answers, but a lot of fun to talk about, and grateful to have somebody to listen. So hopefully get through this at some point. Sorry, so long yabbering on, repeating myself, but clarify. Thanks. Bye.